Imagine a company that's been, well, a cornerstone of global finance for 157 years, now making a really bold strategic pivot to redefine its future. This deep dive into MetLife, ticker MD, isn't just a look at a legacy insurer. It's a fascinating story of innovation meeting deep roots, you know. And whether its big bet on a new frontier can unlock significant value for you, the shareholder. Our analysis suggests this giant, currently trading at an intriguing valuation, might actually be significantly undervalued right now. We're going to unpack whether MetLife is truly on the cusp of a new era of growth.
Exactly. Today, we're taking a comprehensive look at MetLife Inc., specifically as of September 16th, 2025, with a share price of $80.82. Our mission is to sift through all the data from its core business operations to management's latest strategic moves and its overall financial health, to truly understand its intrinsic value and, crucially, the potential impact of this new frontier initiative. This isn't just about crunching numbers, it's about understanding the complex engine of a truly global financial institution.
Let's jump right in then and explore the bedrock of this company. Chapter 1, Business Analysis. Okay, let's unpack this. The report asks a fundamental question. As the global financial landscape is reshaped, has MetLife truly engineered a strategic pivot with its New Frontier initiative, one that will not only defend its legacy but unlock a new era of growth and shareholder value? That's what we're aiming to understand. What's your immediate take on how they're actually doing this?
It's a great question because at its heart, MetLife operates a classic global insurance model. They manage risk and deploy capital for long-term financial security. But the strategic pivot is precisely in how they're evolving that model. Their financial engine is powered by three primary revenue streams: premiums, fees, and other income, and net investment income. The interplay of these is critical.
Right. Premiums are the absolute bedrock, the largest, most stable component. These are the regular payments collected from policyholders across life, disability, dental, you name it. Then you have fees and other income, which is a growing, less capital-intensive stream coming from managing things like retirement plans and various asset management services. But the really significant portion of earnings comes from net investment income. This is where MetLife Investment Management, or MIME, comes into play, investing that massive float, essentially the vast pool of capital from premiums they hold before claims are paid out.
And this creates a powerful business flywheel effect, which is key to understanding MetLife. Those stable premiums provide low-cost, long-term capital. Mime then takes that capital and invests it across a diverse portfolio to generate returns. These returns are what cover claims, operating expenses, and ultimately drive profit. So success isn't just about selling policies, it hinges on incredibly disciplined underwriting and prudent asset liability management. And the entire model is sensitive to big macroeconomic factors like interest rates.
And the product portfolio that feeds this flywheel is extensive. For individuals, you're looking at various types of life insurance term: whole, universal, variable, along with annuities for retirement planning. They even offer specialized options like pet insurance and legal plans. But a real cornerstone for them is group benefits for employers. This is where they offer comprehensive dental, vision, group life, disability, and supplemental health products. What's truly remarkable is that MetLife is the largest non-medical commercial carrier in the U.S. group insurance industry, serving over 55,000 U.S. group customers, including 94 of the top 100 Fortune 500 companies. That's an incredible level of market penetration.
It genuinely is. And then they also have their retirement and income solutions, or RIS, tailored for institutions. This is a highly specialized area, serving institutional clients with complex solutions like pension risk transfers, essentially taking over a company's pension obligations, stable value products, and longevity reinsurance. These are not small, off-the-shelf products. They are large-scale, intricate transactions that really leverage MetLife's deep financial engineering expertise.
You know, what genuinely grabbed my attention in this deep dive was the sheer global footprint of MetLife. I mean, 90 million customers across 40 countries, it's easy to say, but what does that truly mean for their competitive advantages and diversification? We're talking about a titan with a market cap of approximately $53.5 billion as of September 2025. They hold leadership positions: the largest foreign life insurer in Japan, the largest life insurer in Mexico, and the largest annuity company in Chile. And MetLife Investment Management, BIM, is on a trajectory to potentially reach $1 trillion in assets under management. This global scale provides significant diversification against regional economic downturns.
Absolutely. The company's primary value proposition, always with you, building more confident future, really captures it. For individuals, it's about family protection and peace of mind. For employers, it's comprehensive benefits that attract and retain talent. And for institutions, it's about complex risk management. All of this is built on a foundation of financial strength, a long history, and a trusted global brand.
So, with all that scale, how is MetLife positioned to compete in this rapidly evolving market? Let's zoom out a bit and look at the broader industry landscape that's shaping their world in 2025.
It's certainly dynamic out there. Technology is a huge factor, with AI and machine learning now reshaping underwriting, enabling more accurate risk assessment and personalized pricing. Then there's the exciting trend of embedded insurance, which is seamlessly integrated coverage, like getting travel insurance automatically with a flight booking. MetLife's existing scale and group benefits leadership actually position it incredibly well to capitalize on this, accessing massive, low-cost distribution channels without the traditional sales overhead. Economic factors like interest rate volatility also fuel demand for financial security products, and aging populations are driving a long-term demand for annuities. The U.S. individual life insurance market, for instance, is forecast for 6% premium growth in 2025.
It's a lot of moving parts. And how does the competition look?
Competition is intense, no doubt. MetLife faces other well-capitalized firms like Aflac, Prudential, and AIG. While MetLife is trusted, our sources indicate it ranks sort of in the middle on product quality and pricing, competing more on its sheer breadth of offerings and deep, long-standing relationships. Interestingly, its PE ratio appears more attractive than some of its direct peers, like Aflac. The regulatory environment also adds a layer of complexity. The U.S. insurance industry is primarily regulated at the state level, creating a significant and costly compliance burden to navigate.
But despite all that competition and regulation, there are formidable barriers to entry that actually protect incumbents like MetLife, giving them a significant moat, right? We're talking massive capital requirements mandated by regulators, the arduous process of obtaining licenses in each state, which can take years, and, of course, the trust built over 157 years. A startup just can't replicate that overnight. Plus, incumbents have vast historical data for actuarial models, giving them a significant informational and pricing advantage.
Precisely. And that leads directly to their competitive advantages. Brand strength and recognition are core assets. That 157-year history builds essential trust, backed by high financial strength ratings like A+ from AM Best, A3 from Moody's, and AA from S&P. These are critical for attracting and retaining large institutional clients.
And their immense size also translates into significant cost advantages and economies of scale. They can amortize fixed costs, things like technology, compliance, advertising over a much larger revenue base, lowering per-policy overhead. This scale also enables them to handle multi-billion-dollar pension risk transfer deals, which few competitors can even consider matching. They also benefit from moderate switching costs, particularly in group benefits. For large corporations, changing providers is a major administrative burden, which creates a powerful stickiness. With their 55,000 U.S. group customers, including 94 of the Fortune 100.
And finally, a truly unique asset is their sophisticated in-house MetLife Investment Management, or MEM, arm. MEM not only manages MetLife's own general account portfolio, but also serves third-party clients. Generating capital-light, high-margin fee revenue, its expertise across diverse public and private asset classes allows for superior risk-adjusted returns and significantly diversifies MetLife's overall earnings, making it a powerful growth engine.
That strategic pivot relies heavily on execution, so it's critical to look at the team behind it. What does MetLife's leadership track record tell us about their ability to deliver on this new frontier vision? Chapter 2, Management Evaluation.
The leadership team is absolutely crucial for a company like MetLife. It's led by President and CEO Michel A. Khalaf, a seasoned industry veteran who took the helm in 2019. He successfully executed the previous Next Horizon strategy from 2020 to 2024, actually exceeding financial commitments despite navigating the pandemic, and then launched this new frontier vision in late 2024. This signals a consistent focus on disciplined value creation. You look at their crisis resilience. During the 2008 global financial crisis, management actually raised $2.3 billion in capital and maintained its common stock dividend. More recently, during COVID-19, they swiftly activated business continuity plans and ensured uninterrupted customer service. This track record suggests a team that can perform under pressure.
That's a strong point for continuity and stability. And speaking of trust, they also emphasize communication transparency and an ethical reputation, right? Their code of business ethics applies globally, with an impressive 98% employee training completion in 2024. They have a confidential ethics and fraud helpline, and the board of directors operates under a stringent code of conduct.
Yes, that ethical foundation is paramount in finance. And when it comes to capital allocation under this new frontier strategy, management is clearly prioritizing growing the asset management business
Right.
through both organic growth and targeted acquisitions. For instance, in late 2024 and early 2025, MetLife announced agreements to acquire PineBridge Investments, which is a significant $100 billion in AUM, and also investment teams from Mesirow with $6 billion managed assets. These moves are strategic, they add scale, broaden product offerings, and importantly, expand global distribution, especially in the fast growing Asian markets. This follows their 2020 divestiture of the MetLife auto and home business for $3.9 billion. Redeploying capital from a capital intensive property and casualty business to a capital light, fee generating asset management model is a fundamental shift, designed to de risk earnings and, crucially, improve their return on equity.
So it's a strategic move away from capital-heavy sectors into more fee-based, higher-margin businesses. And on the shareholder returns front, management also shows a strong commitment to returning capital, which is something investors always appreciate. They've increased their annual dividend for 12 consecutive years. The annualized dividend is $2.27 per share, which is approximately 2.8% yield with a sustainable payout ratio of 38.40%. They even announced a 4.1% increase in April 2025. And beyond dividends, they're active buyers of their own stock, returning $3.2 billion through repurchases in 2024 and authorizing a new $3 billion program in April 2025. This consistently reduces shares outstanding, boosting per-share value for you, the investor.
What's particularly insightful here is their focus on return on equity, or ROE. While return on invested capital can be complex for insurers, ROE is a more meaningful metric. MetLife's trailing 12 months adjusted ROE is a robust 14.6%. The new frontier strategy aims to increase this target to 15-17% from the previous 13-15%, with that asset management pivot being a key lever for achieving those enhanced returns. It signals a clear path to driving higher value from their capital base.
Let's dig into the numbers and see how all of this is translating financially. Chapter 3, Financial Analysis. As of our analysis date, September 16, 2025, MetLife's market capitalization stands at approximately $53.5 billion, firmly placing it in the large cap category. When we look at their revenue growth trends over the past 5 years, it's been modest and somewhat volatile, which is common in the insurance industry due to market cycles. After a dip in 2020, we saw a solid recovery in 2024 with 6.1% growth, and the trailing 12 months ending mid-2025 showing a similar positive trend. This suggests an improving top-line performance, aligning with their strategic shifts.
And those trends are reflected in profit margins as well. They fluctuated, sensitive as they are to investment markets. While there was some margin compression between 2020 and 2023, MetLife has seen a solid recovery in 2024-2025. Their net profit margin, for instance, has rebounded to around 5.83% for the trailing 12 months. This rebound isn't just market luck, it largely reflects a more favorable operating environment and the early benefits from their strategic shifts, suggesting operational improvements are starting to take hold.
What truly stands out isn't just MetLife's consistent free cash flow generation, but its remarkable resilience even in volatile periods. This robust cash flow grew from $12.35 billion in 2021 to $14.60 billion in 2024, consistently funding shareholder returns without external strain. The New Frontier plan's ambitious target of over $25 billion in FCF over the next 5 years isn't merely about growth. It signals a fundamental reengineering of their capital engine, shifting towards a more self-sustaining model. That could significantly de-risk future growth compared to some peers.
Now, when we talk about earnings consistency, looking at GAAP EPS can be misleading for insurers. It shows significant volatility over the past decade, largely due to non-cash accounting adjustments on their massive investment portfolios. For example, EPS dropped from $7.65 in 2021 to $1.81 in 2023, only to recover to $5.94 in 2024. That's why management often emphasizes adjusted earnings, which provides a much clearer operational picture. By stripping out those non-recurring or market-driven fluctuations, allowing us to see the true health of the underlying business.
Similarly, traditional financial ratios can be deceiving for insurers. The debt-to-equity ratio, for instance, can appear high, ranging from 0.55 to 1.72. But for an insurer, this isn't necessarily a sign of distress because policyholder reserves are a significant liability. Instead, it's more helpful to look at debt serviceability. MetLife has a strong interest coverage ratio of 6.3x and operating cash flow covering debt by 31.8%, which comfortably indicates sustainable debt levels.
And the traditional current ratio, comparing current assets to liabilities, isn't a meaningful liquidity metric for an insurer at all, and often appears very low, sometimes around 0.12. Insurers intentionally match long-duration liabilities with long-duration assets, A better measure is their holding company cash and liquid assets, which totaled $5.2 billion in Q2 2025, comfortably above its $4.0 billion target buffer. This shows they have ample liquidity for their operational needs.
But one area where there's no confusion is dividend stability and growth. MetLife boasts an exemplary record, increasing its dividend for 12 consecutive years. The 4.1% increase in April 2025 and that conservative payout ratio of 38-40% make it an attractive proposition for income investors looking for reliability.
Now for the valuation analysis, which is where things get really compelling. From a relative valuation perspective, MetLife appears attractively priced. Its trailing 12 months PE ratio is approximately 13.6 as of September 2025. What's important is that this is significantly below its 10-year historical average PE of 20.26 and its 5-year average of 15.86. It also trades favorably compared to its peer average of 18x and the broader U.S. insurance industry average of 14.4x, and at a notable discount to competitors like Aflac, which has a PE of 24.1. This suggests the market isn't fully recognizing its value yet.
Beyond just comparing metrics, understanding intrinsic value is crucial for a long-term investment mindset. As you know, for a company like MetLife, nailing down that intrinsic value often comes down to a robust discounted cash flow, or DCF analysis. This method projects future free cash flows and discounts them back to today's value. It forces us to take a critical look at future growth, profitability, and risk, aligning perfectly with a long-term business owner mindset.
And when we look at consensus analyst models, they strongly suggest MetLife is currently undervalued. Fair value estimates range from $91.79 to $111.95 per share. Compared to the current $80.82, this implies a potential undervaluation of 14% to 28%, indicating a meaningful margin of safety for investors. These models rely on forecasts of robust earnings growth, around 11.81% per year, supported by approximately 4.7% annual revenue growth. This projected growth is clearly driven by the New Frontier strategy and the expansion of their asset management business. A representative analyst model uses a discount rate of 7.68%, accounting for the time value of money and the inherent investment risk.
Let's turn our attention to part 2, the broader picture and future, starting with how the market is actually viewing MetLife. Chapter 4, Market Sentiment.
The prevailing Wall Street sentiment for MetLife is quite positive, with a moderate buy consensus rating. The average one-year price target is approximately $95.12, which suggests significant potential upside from its current $80.82 price. Recent buy or overweight ratings from major banks like UBS, Morgan Stanley, Wells Fargo, and Barclays, with targets in the $91-$98 range, reinforce this bullish outlook. It's clear the street sees value here.
That's a strong indication. And how has recent news flow impacted this perception?
Recent news has been broadly neutral to positive, primarily focusing on MetLife's disciplined strategy execution. This includes routine dividend declarations, that new $3 billion share repurchase authorization in April 2025, and positive coverage of its asset management acquisitions like PineBridge and Mesirow as part of the New Frontier strategy. There's been a notable absence of negative headlines, projecting a sense of steady progress and confident management.
What's truly fascinating here is that short interest for MetLife is exceptionally low, just 1.35% of its float, and it's actually been declining. This is significantly lower than its peer group average of 4.99% and suggests a distinct lack of bearish conviction among market participants, acting as a pretty strong bullish sentiment indicator.
Technically, the picture also looks positive. MetLife's stock price of $80.82 is currently trading above its 50-day simple moving average, which is between $78.24 and $80.09. This signals positive short-term momentum. Furthermore, the price is also above its 200-day simple moving average, approximately $78.25 to $70.72, indicating a sustained long-term uptrend and reinforcing a positive technical outlook for the stock.
Let's delve into who actually owns MetLife and what that tells us. Chapter 5, Ownership Structure.
Ownership is overwhelmingly dominated by large, sophisticated institutional investors, holding approximately 95% of the common stock. Top holders include Vanguard Group with about 8.6%, Dodge & Cox at 8.0%, and BlackRock at 7.1%. The substantial stake by a deep value firm like Dodge & Cox is particularly noteworthy. It suggests a strong belief in the long-term intrinsic value of MetLife.
And what about insider activity? Are the people running the company buying or selling?
Insider ownership is modest, around 0.2%. Recent insider activity shows mostly acquisition, non-open market trades, which are typically compensation-related. Crucially, there's been a notable absence of significant open market selling. This suggests that insiders don't currently view the stock as overvalued, which is often a comforting signal for outside investors.
This high concentration of institutional ownership is also interesting, with the top 25 shareholders owning nearly 66% and the top 3 controlling over 23%. This ensures a high level of professional oversight and accountability for management, which can be a double-edged sword but often beneficial for long-term strategic alignment.
Exactly. Such concentrated ownership means management decisions are under intense scrutiny from sophisticated investors, which can lead to better long-term governance and performance.
Now, every investment carries risks and opportunities. Let's weigh those for MetLife. Chapter 6. Risk Assessment. We'll do this through a SWOT analysis, starting with strengths, MetLife's core internal competencies.
For strengths, MetLife benefits from its global brand and immense scale, built on 157 years of trust and operations in over 40 countries. It boasts a highly diversified business mix across products like life, health, annuities, and asset management, and across various geographies. Its financial strength is robust, backed by high financial ratings, and its in-house MIM provides distinct investment management expertise. Finally, its entrenched market leadership, especially in U.S. group benefits with those deep relationships across Fortune 500 companies, provides a stable earnings base.
On to weaknesses, which are its internal limitations.
Here, we see a continued dependence on the mature U.S. market, which can be slow-growing and highly competitive. There's also relatively limited product differentiation in some areas, which can lead to price competition and margin pressure. Profitability is inherently sensitive to macroeconomic factors, particularly interest rates. And the runoff of legacy products within MetLife Holdings creates a drag on overall growth.
Now for the opportunities, the future market potential they can tap into.
The strategic focus on expanding MIM offers high-margin, capital-light revenue growth, which is a major opportunity. Demographic tailwinds from aging populations globally will continue to drive demand for retirement products. There's significant potential in leveraging AI and data analytics for efficiency, cost reduction, and enhancing the customer experience. Embedded insurance presents new low-cost customer acquisition channels in digital ecosystems. And finally, economic development in emerging markets in Asia and Latin America provides a long runway for future growth.
And finally, the threats, those general external challenges.
Threats include intense competition from both large incumbents and agile insurtechs. Changing workforce dynamics, like the rise of the gig economy, could potentially shrink the traditional group benefits market over time. Evolving customer expectations demand more digital, seamless experiences, which requires continuous investment. And of course, regulatory risk remains ever present, with stringent and evolving requirements across multiple jurisdictions. This raises an important question. How vulnerable is MetLife to external economic forces like inflation and interest rates?
That's a critical point for any financial institution.
Absolutely. Interest rates are a dual-edged sword. Persistently low rates compress investment spreads and can make it harder to generate returns, while rapid spikes can cause mark-to-market losses on their fixed income portfolios. Stable, moderately rising rates are generally ideal for insurers. Inflation is also a dual threat. It increases claims costs for health and disability benefits and erodes the real value of fixed life insurance benefits, potentially reducing their attractiveness to consumers.
And as a global company, MetLife is certainly exposed to geopolitical risks. The U.S. tariffs of 2025, for example, are forecast to slow global GDP growth, which in turn reduces demand for insurance products. This can also contribute to fragmented economies and prolonged inflation, negatively impacting claims costs, currency exchange rates, and the performance of their international investments. Okay, we've covered a lot. Let's bring it all together. Chapter 7, Conclusion. So what does this all mean for you, the investor? The bull case for MetLife rests on a high-quality, durable business available at a compelling valuation. It has a formidable economic moat built on its global brand, immense scale, and those entrenched customer relationships, particularly in U.S. group benefits, which provide stable earnings and cash flow. Management is clearly shareholder-friendly, with a strong track record of execution and prudent capital allocation, notably that strategic de-risking pivot to asset management. And as we discussed, the valuation appears compelling, trading at a significant discount to historical averages, peers, and our estimated intrinsic value.
Conversely, the bear case primarily focuses on macroeconomic factors and industry challenges. MetLife's reliance on the slow-growing U.S. market makes it vulnerable to a significant economic recession. Its profitability is highly sensitive to interest rates. Prolonged low rates compress earnings, while rapid spikes can lead to investment losses. The success of the New Frontier strategy, while promising, isn't guaranteed. And intense competition from both incumbents and new entrants could certainly impede growth if not effectively managed.
As we discussed, our intrinsic valuation models based on projected future cash flows suggest MetLife shares are currently undervalued, with a fair value range around $91 to $92 per share.
So, as of September 16th, 2025, MetLife Inc. presents as a high-quality, mature business with strong competitive positioning and a management team acutely focused on shareholder value. Its current share price of $80.82 trades at a notable discount to its estimated intrinsic value range of $91–$92 per share. While it faces persistent macroeconomic and competitive risks inherent to the industry, this valuation appears to offer a meaningful margin of safety for the patient, long-term, value-oriented investor. The blend of a stable, cash-generative core, a promising asset management growth engine, and a clear commitment to capital returns provides a solid foundation for potential future upside.
Considering MetLife's 157-year history and its strategic New Frontier initiative, what could the next decade hold for a titan that is actively re-engineering its core business model to thrive in a rapidly changing world? How might its legacy status actually become its greatest leverage point for future innovation rather than an anchor? If you found this deep dive valuable, we encourage you to like and subscribe to Stock Analytics AI. For just $4.99 a month, members get priority deep dives on specific tickers, and we're covering all of the S&P 500 stocks over the next few months, with members getting exclusive priority access. Plus, if you want a one-off deep dive on a stock important to you, just drop us a super thanks.
Remember, this analysis was generated by an AI system for educational purposes only and should not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.